All right, now up next here is Puda Coal Pud C. This is actually a bulletin board stock. So you can see we got this huge sell-off here, and then kind of a steady lead-in bearish trend coming all the way down to about $1. And actually, the breakout signal was down here on this breakout above this neckline, descending neckline here. On huge volume, you could see on that day when it pushed above $1. So that was the actual breakout buy signal. This was back in '07. I was a lot more gutsy back then. I was a newer trader, and I had only seen a bull market at this point, and I bought up at 127, and then it actually rose all the way up to 150. If I recall correctly, there was some big news out about this stock, as well as which was why that these huge spikes in volume came in, as well as this spike in price action. So even looking at this chart here, looking at around 125 where I bought, looks like a good midpoint buy point to buy at the midpoint of the breakout candle, right around 125. So going forward, you can see that's exactly what the stock chart did. It came back down to the midpoint of the breakout candle, found support right there, kind of just hung out there for a short while before finally breaking out of this pennant formation or flag formation here. So that was another short-term buy signal as it broke out above this pennant or flag formation, and then it rallied all the way up near about $2 whole number resistance right there. So you can see this was a huge reaction from 1 to 2, 100% gainer in about a week and a half or so. So I made 45% on this trade, going long at 27 and exiting up near $2 whole number resistance at 185 for 45%. Here's another revival pattern. As you can see here, lead-in trend is bearish, and then we got kind of this stock stalling out up here at $1, and then we got this big spike in price right here with volume, and then kind of this flag formation. So this is almost kind of a short-term survival pattern. As you can see, we got the run-up in price followed by a short-term sell-off with a consolidation and a breakout on big volume, which also broke out above 1. So anything breaking out above 1 in a somewhat of a foos pattern, no matter if it's short-term or long-term, that could be a big indication of, at least a short-term, really quick 20% move. So moving forward, that's exactly what it did. We got this big jump up in price action. Kind of just stalled out during the day, and then the second day actually gapped up to 150 to open up at 150. So I took advantage of that gap open, took my profits at 143 for a 38% gain. And additionally, if you were long this stock at 103, you'd want to sell it if it started dropping down below this neckline, or you could be riding the 13 EMA trend. In this case, if you were riding the 13 EMA trend, it came down and retested it twice and rallied back up, so it looked like it was possibly going forward from there, but it actually ended up breaking down the 13 EMA shortly after and going back down below where we bought it from at 103, and then you would have gave up, a huge, nearly 40% gain. So, you got to take your profits and move on and stick to your stops. Here's another revival pattern that actually this was RDN. You can see here the lead-in trend was bearish. Then we got the beginning of this three-phase breakout pattern, and you can see the volume increase down in these levels from when it was trading up here. So there's a lot of buying interest and just a lot of trading activity going on when the stock was down at these really cheap prices around $1. So I mean, you can see here this went from about $1 up to $2 in just 2-3 days. So this stock was very volatile. I mean, look how small this candle is right here. But if you look at the percentage gain, that was a 25% move, just this little candle. So, this was a very volatile stock. But I was thinking that, this was a false breakout. But overall, this was kind of in phase 2 right here. And I was anticipating a possible phase 3 breakout, with a profit target upwards of around 3. So going forward here, that is what happened. I entered on this day. And then we kind of gapped open and failed, but we were still above the 13 EMA, so the trend was bullish, and we hadn't broken out yet, so there was no reason to really sell the stock unless it broke down the 13 EMA. And finally, on this day, we got a big breakout up about 250 on big volume, and actually stalled out at this past peak resistance. And then the second day, it opened actually gapped down, and it had a short-term run up. As you can see, that short-term shadow or the upper shadow here means that the stock rallied up here and then actually fell back down. But after the stock gapped down, I was a little bit cautious about the stock, and I took advantage of that short-term rally when it rallied up intraday, and I sold at 251 for a 35.68% gain. And then from there, it rode the 13 EMA all the way up to 3, and then blew up all the way past 4 to 450, almost to 5 even. So you could have rode the 13 EMA on this stock, sold at the next whole number of 3, sold at the next whole number of 4, even up near this whole number of 5. So you could have sold into these strengths if you were just holding on to the 13 EMA that whole time. And then after it peaked out at 5, 5 is usually pretty strong resistance point. It crashed all the way back down to 3. Going on here, here's another revival pattern. You can see here it's kind of we got this descending trend line as well as this horizontal trend line coming in here with the past peak right here, price dipping down here, so there's a decent amount of neckline support and resistance on this horizontal line here. So next stop is either going to be 3 or up near 350 where price was also peaking out, or the past peak was up near 450. So profit targets around 350 area, 450 area, and then very short term is the next whole number at 3. But going long at 256, I'm looking for a bigger profit target than just $3 per share. And as you can see here, we got big volume on this breakout above the neckline resistance point. So you can see here, actually going forward, it retested right exactly at the breakout support, as well kind of near the midpoint of the breakout candle. That's always where it could be a potentially very strong buy. Excuse me. A very strong buy on the dip right there near the midpoint of the breakout candle, and additionally to the breakout support. From there, it just blew up, and I took my profit at 321, just taking advantage of this strong candle on this day. And we were pushing up kind of near these past peaks over here, so I just locked in my profit for a 25% gainer. Then going forward from there, I just kind of rode the 13 EMA, breaking it down, but still maintaining prices above it, and then actually peaking again at 375, where I was peaking out back here before falling all the way back down to where we bought it from. Here's this is another gold pattern. This is back in late 2006, early 2007. This is RPTN. This is another NASDAQ bulletin board stock. So looking at the short-term chart here, we got a pretty solid looking short-term force pattern. We got that first rise in price action in phase 1 with volume, followed by the phase 2 consolidation, and then we get that big breakout to new highs, actually in even above 1. So this is actually, that's showing the gold pattern right there. And then I went long on this stock on a dip at 116. So I actually didn't buy it on the day of the actual breakout here. I missed the buy-in at 1. So I went and tried to buy in this stock on a dip, and that's exactly what it did. I ended up buying in at 116 here. So going forward, you can see after that dip buy to the midpoint of the breakout candle, which is always that key spot on big, long, strong stocks that have big, strong breakout candles. Just going from there, it kind of was just blowing up, then consolidated in a flag, and then broke out again, pushing up towards about 180, and then we formed this other flag pattern here that actually broke down, and also broke down the 13 EMA, and that's actually where I sold at, was at 154 as it was breaking down this flag pattern and the 13 EMA. So I got out for a 34.48% gain, which was an awesome trade on this gold pattern slash short-term force. But you can see there, as it was a gold pattern, these easily go from $1 to $2 in a very short amount of time if you have the patience. This one didn't hold up along the 13 EMA. It did make that short-term bounce or move back down all the way down to the 120 level before it rallied up to 2. So you definitely want to take advantage of these multi-day to multi-week rallies so that you can lock in your profits, and that's exactly what I did. Locked in 34%, made a killer trade. Looking at the longer term chart, This is the same stock, RPTN. You can see here the gold pattern. So we got the 1 year, 2 years, almost a little over 2 years of the gold pattern forming up here. And then on the short-term scale, it took about 4 months to form this short-term force pattern that broke above the 1 on the force, and then longer term you could see that this was the gold pattern in play, which indicates a possible run upwards of $2 per share. Here's another one, SKNN. This is another NASDAQ bulletin board stock. This is, these bulletin board stocks can be very risky and they're very speculative because, stocks that trade on the bulletin board exchange are majority they're piles of crap. They're companies that are just trying to make it. They don't really have a solid foundation for a business, and most of these companies never make it to a major exchange. But this company, SKNN, Skins Inc., I'm actually not even sure if they were still around anymore. This was a while ago. As you can see, this was November 9th, 2006. But what this company was, they were a shoe company that made these weird insoles, so you'd actually have one shell for your foot, and then you could actually wrap around that shell different styles. So it was basically like, that's why they're called Skins, Skins Inc. So it was, you'd wear a shell for your shoe, and that was actually called the bone, and then there was different skins that you could wrap around the bone, so you could have multiple styles for the actual same shoe. So it was a cool concept that sparked my interest and a lot of other people's interest in this trade as we were following it. And so as the news came out about multiple sales they had, we got this big spike in volume plus price that actually broke out to the stock's all-time high. So this was definitely sparking some interest in me to trade this. So I was looking to buy it near the midpoint of this breakout candle. About 150. The actual midpoint of the breakout candle is about 145. So going forward, I actually did buy this stock at 148 down here, and it even fell down below the 13 EMA. This was back in 2006. At this point, I had only been trading for, maybe about a year. So I didn't really know, I wasn't that diligent with my stop losses. But, I also, these are, as I said in the beginning of this DVD, my foundation for this strategy I built in my first year of trading that I learned at the website 3 Stocks on Fire. So I recognize this pattern as a potential pattern that could be, very profitable. So I went long on this dip at 148, and then actually bounced off the 13 EMA after slightly breaking it down, and rallied all the way back up to the highs above here, and then kind of came back down. And that was actually this first spike that we had on that. When I first noticed the stock was actually phase 1 of a 3-phase breakout triangle pattern. As you can see here, we got that rise in price plus volume, followed by the phase 2 consolidation, and then phase 3 breakout on volume to new highs above 180 here. And that move from 180 sparked this stock to move all the way up to about $3 per share. But this is a bulletin board stock, so when these things go up, they certainly do crash. So I took advantage and sold this stock at 242 for a 63% gain, and moved on. And then after that, it peaked out at 3. Perfect example of whole number resistance in play here, of where you want to potentially take profits. I'm not that patient. I know that this stock can potentially move up to 3. That's the next whole number, but I'm not going to be greedy. You need to take your profits, and I had a huge 63.51% gain, so I moved on and locked in my profit. Okay, so looking here, this is actually the same stock we were just looking at on the past slide. This is SKNN. As you can see, the company never made it to anywhere. A year later, now the stock's all the way down at 20 cents, where it was peaking out at $3 per share. So these companies are piles of crap. You can't get stuck in one of these stocks and get married to them. That's what happens. People buy stocks like this. Back up here. At like $2.80 per share. They're thinking this thing is going to make it to the NASDAQ, and they're going to get rich and be millionaires off the stock. And then all of a sudden, they bought it up here, and then it breaks down to 180, and they're thinking, oh man, this has to bounce back up from here. And little do they know, a year later, the stock's going to be down at 20 cents. So, never marry a stock. You can't get stuck in with these positions, and these are all bag holders down here that are still waiting for this stupid stock to come back up. But you have to take advantage of the short-term gains and just get in and get out. We're not long-term investors here. We're learning about short-term swing trading. So you buy into the breakout, you sell into the strength, or you get stopped out. That's basically the rundown of how to trade this strategy. So looking here, back on SKNN, we actually had a revival pattern form up after this bottomed out at about below 20 cents here. So we've got the stock was kind of flattening out. We got some increased volume over here, and then we peaked up right here, kind of forming a another resistance point at 40 cents, and then it fell down. And then we got this big spike in volume and price, which was kind of a short-term three-phase triangle breakout here with the pop above 40 cents resistance with volume coming in. So I bought into this breakout of this revival pattern at 45 cents. You'd want to put your initial stop about 40 cents or so if the stock started breaking down below that point, or that could either be a buy point on the dip if you're looking to buy near the midpoint and thinking the stock could head higher from there. So going forward, as you can see, the stock actually did dip back down to the breakout point, so that could have been a strong buying area if you're looking to buy in on the dip. And then the stock actually blew up for about 2 days session, and then kind of consolidated into this flag pattern or pennant pattern that actually broke down to the downside, and additionally broke down the 13 EMA on the same day. So I took this as a sell signal that I should get out of this stock. I sold at 56.5 cents. For a quick short-term 25% gain. As I said, every trade I make, I'm looking for a 20% plus gain. So if I get above 20%, that's when I'm thinking, okay, maybe I should start thinking about exiting this position. Don't be greedy, thinking that this thing's going to go to the moon. Lock in your profit and stick to your stops. Going forward, here's a Fus Force pattern that I actually bought into anticipation of the breakout. So as you can see here, there's the phase one with the rise in price plus volume. Then in phase two, it kind of just rode along the 13 EMA here, bounced off the 13 EMA, came back and peaked out at 150, then peaked out again around 150 here, and then was traded around the 13 EMA support again, and then kind of bounced off it with a spike in volume and a strong candle. So I was anticipating a breakout above the neckline resistance here on this pattern of the Fus Force pattern. So I was long at 141. So going forward, as you can see there, 2 days later, the stock blew up above the neckline resistance with a very strong white bullish candle. And as you can see here, the stock came back down, retested that always trusty midpoint of the breakout candle, which is a solid spot to buy a breakout stock on the dip if it's got a really strong Fus 4 pattern. And then from there, the stock rallied off this and then came back up to $2 per share. I actually sold at $2 per share on this day when it gapped open and rallied over there because that was the next midpoint, or not the next midpoint, the next hold number resistance level, which was your first target. So that was a 43% gain. Then I was still riding the trend on the stock here, and then we got some more upside momentum. Then we kind of had this weird candle day where it sold off and rallied back up, and that kind of sketched me out. So I sold at 228 on this day for 61%. But then from there, it formed this other pennant formation that broke out to the upside and went all the way up to 375. So you could have been riding the 13 EMA here the whole time, and just watched as this stock blew up, and then you could have even sold at the next whole number resistance here at $3 per share. So that's just another example of you never know how high the stock's going to go. So sometimes you might just want to follow the 13 EMA, and it might just keep going and explode. Up next here, this is UA. This is actually United Airlines. This is a revival pattern. So you can see here, this stock had a major sell-off all the way up from 40 down to about 250 on the low, and it never really broke out above the 13 EMA. It tried to a couple of times, then tried to here again, but it failed every time. And then finally here, it started trending above the 13 EMA, got a really strong candle on huge volume, and then the $10 resistance whole number is a pretty strong area of support and resistance, and that's exactly where the stock peaked out twice. So this was actually a survival pattern, a short-term survival pattern that I bought into on the breakout above this kind of pennant formation. So you can see here that first rise in price, followed by a sell-off, and then a mini consolidation on a breakout. So I went long at 844 on this stock, anticipating the stock is going to break out above this neckline resistance above $10 per share, or it's a little bit above 10, as you can see there. So going forward, as you can see, after this breakout when I bought in right here, the stock just kind of traded along here. It was stayed above the 13 EMA, so this trend is still bullish as always, as long as it's above the 13 EMA. Then finally broke out officially on this day right here, and then I sold on the second day of the breakout. This peaked up to 14 and then sold off into the close. I locked in a 54% gain at 1302, and then from there, you still could have rode the 13 EMA all the way up to about $16 per share. But I'm not that patient of a trader. I take my profits as they come and move on to the next trade. Here's another trade, ANPI. This is a small cap biotech stock. So the longer term chart here was actually a gold pattern. On the long term, it actually broke out above 1 on this day. It's kind of a sketch play because there wasn't a very clear breakout above 1 here, but there's a huge volume in here, and then it actually went all the way up to about $2 per share from this breakout above 1. So I actually didn't play any of this pattern here. I actually was after this came back down, bounced off that very strong psychological support of $1 per share, and then rallied. So this was almost a kind of a very, very short-term mini survival pattern. So I had a feeling that this stock could see some more upside potential. I ordered a half position at 126, and I alerted members that I was going to be looking to potentially buy this stock on a dip back down around the midpoint of the breakout candle, or pull back to the 13 EMA. So going forward, this stock dipped back down. It actually had a huge gap up here, and I was still holding the stock, and then the stock dipped, and then it actually on this day when it dipped back down, I bought another position at 115. So now I was averaged in at 120.5, and we're still riding above the 13 EMA, so we're still looking bullish here, and we're actually kind of forming this pattern going on. So this could be a phase 3 pattern with this phase 1 right here, and now we're kind of consolidating above the 13 EMA but below the highs of the last peak. Then moving forward, you can see after I bought my second half position on this day, then this day it didn't really do much, but we're still above the 13 EMA. And then all of a sudden on this day, we got this huge spike in price action. This was actually on a news release that came out, and that was actually gave us some really strong momentum going forward. And then the next day it gapped open, and I took advantage of that strong gap. Sold at 217 for an 80% gain on this trade. So from there, it came back down and actually bounced off the 13 EMA twice again before going all the way up as high as $3. And then it actually broke down the 13 EMA trend finally here, which is a good sign of a trend reversal. And here's another small cap biotech stock that was during kind of the same period that was on the move. As you can see here, we got that first spike in price, followed by a sell-off, followed by a breakout of a survival pattern. As you can see here, this big volume coming in, and then so the resistance zone is the past peaks right here, up around 180 or so, in the 180 range. So I went long in this stock in the 140s right here as this was breaking out, and then we got this huge candlestick on this day that actually broke out to new highs above the survival pattern. And looking here, we're above 2. The stock is looking like it could just skyrocket from here because we got this really strong candle plus volume. And then this guy named Adam Furstein, who works for TheStreet.com, actually came out with a report saying that he thinks this company's garbage. Pretty much all he does is writes about biotech companies that he thinks is garbage. So he screwed us on this position. He wrote an article overnight about it, and then the stock was dropping after hours. And so we actually sold back down here at 176. We had a huge gain on it, but we still locked in 24%. And this is actually closing below the midpoint of the breakout candle. So this is there's bad news and sentiment out about the stock, and actually formed that bearish cloud cover candle that broke down below the midpoint of the breakout candle. So that's a pretty good indication as well that the trend might be bearish going forward. And you can see from there, it didn't really do much for the next several months. Here's another survival pattern. This is Dan. This is actually the first pattern that I was talking about, or the first example of the future fair value pattern. Dan, I actually did trade this, just a very short-term trade. I didn't trade the stock actually from when it made that huge move all the way up to $7 per share, but I did trade this for a solid gain on a FOOS survival pattern. So as you can see there, the first huge run up on volume plus price, and then the sell-off, but not a complete sell-off. The stock was kind of consolidating, and then it broke out above this above the 13 EMA. This was kind of not a very clean survival pattern, but it did break out above this descending triangle formation on huge volume. So there's definitely some volume coming in there and some momentum. So I was long at 140, and then another breakout signal would be on a move above here. Profit target would be about $2. Hold number resistance upwards of 260 area where the past price peaked out. So going forward, I locked in my profit right around here at this past peak resistance, and it also spiked out and it peaked up around $2 per share and failed to break out that. So I locked my profit in at 185 for a 32% gain. Just a quick single day trade, and you're in and out. And you got to lock in your gains. You can't be greedy, because you can see here the stock peaked out at $2 per share and dropped all the way back to 120. And then actually on this breakout above 2 is when it actually rose all the way up to about $7-8 per share from that future fair value example. Here's another survival pattern slash force pattern. This is NVAX. As you can see here, it kept spiking up, and then spiking up, but it never really did anything. But it was forming this overall triangle pattern, forming a force pattern. So I bought in on this kind of mini survival, or mini revival, you could even call it, pattern here as it broke out above this short-term consolidation, as I was expecting it to rally up again. As you can see here, every time it came back down near the 13 EMA, it had a huge spike off that 13 EMA support. So I was trying to buy in here in anticipation of this breaking out to the upside of this FOOS force pattern. So I went long at 293. Now going forward, you can see I was buying in here, and then we were just kind of riding the 13 EMA all the way up until we actually did break out above this FOOS force pattern. And then from there, first target is going to be around $4 per share, whole number resistance. In addition to that was around where the price past peaked out at. So I sold at 410 for a 40% gain. The stock eventually rode up to 5, so there's definitely more upside potential. But as always, you're never going to catch the bulk of the move. All we're trying to do is find stocks that potentially look like they're going to make a strong move, and we just want to catch at least some piece of that move, and that's what the goal is every time for every trade. Alright, so I just went over a bunch of winning trades, making trading look pretty simple and easy. You just buy into these breakout chart patterns and sell into strength, then you're good to go. But as I said before, my strategy, you're only right about 50% of the time, so you're going to be taking a lot of losses, and if you can't accept that losses are part of the game, you're not going to win, because if you can't learn to cut your loss short, and you have a bunch of big, huge losses because you're too stupid and not disciplined enough to accept the fact that losses are part of the game, then you're not going to win. So basically, your winning trades need to be at least about double gained than that of what you lose. So if your average winning trade is $1,500, then your average losing trade needs to be $750 or less. So it's just all about that 2-to-1 ratio. The potential risk for reward is you're shooting for a win that is at least double than what you're willing to lose. So I'm going to end this DVD going over a whole bunch of losing trades, just to stick it in your brain that cutting your loss short is the most important part of trading, and you need to accept the fact that losses are part of the game, And if you can't accept that, then you're not going to be successful ever in the stock market. So let's get started looking at some examples of some losing trades and how I was able to cut my loss short. Okay, so looking at this first trade here, this is AEZ. We got a revival pattern in play. As you can see here, we got the lead-in trend as bearish, and then finally kind of bottoming out here at about $3 per share. But it formed this neckline here, resistance, that gave us an indication to buy into. We got that first spike in price plus volume here, which led to the breakout, and then actually formed a flag pattern here, where it kind of retested the support line of the breakout as well as the 13 EMA. So I bought in kind of on the dip here. Actually, it was as it was breaking out above this flag pattern. So I didn't buy in exactly on the dip. I bought in after we got confirmation of the stock looking to go forward above this this flag pattern here, and we had that huge volume on that day. So first target would probably be around $5 per share because it's the next whole number. Resistance, and in addition, that's where price past peaked here. So going forward, you can see that after these 2 days of big volume, the stock never really found any momentum going forward, and it actually broke down the 13 EMA here. So I cut my loss and sold at 395. In addition, it broke down a whole number support at $4 per share. I cut my loss at a 6.18% loss. So you have to take your losses. You can't just not all these trades work out in your favor. You can buy into them, buy in on a dip, but maybe you bought in a dip and then next thing you know it breaks down. So you have to be extremely disciplined, and you must cut your losses. So looking forward here, as you can see, I did get stopped out here, and it retested the breakout support again and actually rallied back up again to actually meet that whole number resistance at $5 per share. So while I did get stopped out and the stock bounced back up, it peaked out here at 5 and then finally broke down all the way to 3. So stuff like this happens on every trade, where you get stopped out and it might shortly rally afterwards, and you're sitting there thinking, man, I shouldn't have sold. But you just have to be disciplined, set a trading plan, and stick to it. Otherwise, you might be somebody that's stupid enough that would watch this whole thing happen and then think they're really smart that they didn't get stopped out down here, and then see it break out to 5, and then they're still sitting up here, and then all of a sudden they didn't take their profit, and now they're sitting down here just looking like a really big idiot because they were just too stupid and too stubborn to ever push the sell button. You have to, the same thing with taking profits, same thing with taking losses. You have to be able to sell a stock. You can't get married to any position in any circumstance. I don't care what you think you know about the stock. If you get a trade that's going up and you're in a huge winning position, you have to take your profit. If you go into a position and it's not working out and it's going against you, I don't care what you think about this stock, you need to get out. It's the exact same saying that I said before. When the chart's talking, it pays to listen. It doesn't matter what other influence, external influence outside of price action is doing. The only thing that truly matters when it comes down to every trade is what is the chart doing. So you just need to listen to the chart and base your decisions off of that overall. Now going forward here, BLC, we got this long-term, pretty bullish-looking revival pattern here. You can see this reverse, this bearish trend leading here, and then we have this solid neckline formed at about $2 per share, just again showing that strong hold number resistance in cheap stocks. So we got that breakout above here at this three-phase triangle pattern, and it broke out on volume. So I went long at 208. This looks like this could easily make a move at least to $3 per share, going forward. But to cut your loss short, you'd want to be selling on a breakdown of this horizontal neckline and cut your loss, because you never know if this is going to be a winner or a loser. So going forward, you can see it had a short-term move up and didn't really do anything, and then this kind of had this strong selling candle day, and then it kind of bounced off the support line as well as the 13 EMA before eventually breaking down $2 per share in the neckline. So I took a loss at 195 for a negative 6.25% loss. And then you can see about a month later, still nothing happened. It's just still hanging out down here. Here's another revival pattern here. As you can see, the lead-in trend followed by this three-phase breakout formation candle that broke out above here on strong an increase in volume. So I was long at 409 on this stock on the dip actually as it came back down to the 13 EMA. I bought in on the dip at 409. Looking for about $5 per share here, upwards of six. There's going to be a solid resistance zone formed here between the whole numbers 5 and 6, and as you can see, the past resistance level was formed around 5 to 6 range. So that was my profit target. Otherwise, you'd want to be selling this stock on about a move below the 13 EMA. You could be using now that it's above the actual breakout zone. So going forward, you can see that this stock didn't do much of anything, and it actually broke down the 13 EMA as well as the breakout support line here. I ended up getting out at 385. Took a negative 5.87% loss. What a lot of people do is they think that they're, they see it break down, but they just can't get the guts to pull the trigger and just accept the failure. And that's when you get into trouble, and you're what should have been a short loss, a short loss cut short of, like I said, 75 to 10% is usually where I try to keep my losses, for maximum. If I can keep it under, a 2% loss, that would be much better. But I try to keep my maximum losses about 5 to 10% because I'm shooting for my wins are 20% above, double that of what I'm risking or more. So going forward here, you can see what happened. As soon as the stock broke down the 13 EMA and failed this breakout, the stock just continued to ride the 13 EMA now on a bearish trend all the way down to 250. And so people that hold on to this stock, they keep holding it, hoping that the stock is going to come back up, and they're just so stupid that they can't get out of the position. Now they're down on this trade, down at 250, and they're asking me, saying, "Foos, what should I do with this stock? I bought it at 4 something. Now it's at 250. Should I sell it here or should I hold it?" It's like, I don't know what the hell this stock is going to do from here. It formed this pattern to buy into. I can have an idea of what the stock's going to do here. I'm hoping that it goes up, but if it doesn't hold up above support levels, then you have to get out of the stock. That's another what I was talking about earlier, how counterproductive it is to hold a stock as it does something like this. You could either have sold this stock right here for a 5.6% loss and had that free cash for something else, for a new trade that could be coming into play. But if you're too stupid and not disciplined enough, you're sitting on that position still, and actually your money just keeps going down because it's a losing position. So you have a much better chance of winning and surviving the game by cutting your loss short and put that money towards a new position that looks like it could be on the beginning of a new move, rather than sitting on a trade that didn't work out and hoping that someday it comes back up. So on to another trade, CHCG. This is another revival pattern. A thing that you're going to notice here is that most of these losses I'm showing you are from revival patterns. The reason being is because revival patterns are probably the stock that I lose on most. And that's because, the overall trend of this stock is already bearish, So when these stocks rally, there's still a pretty good amount of bearish sentiment on these stocks. So when people see this stock rise, this may just be looked at by some as just another opportunity to short this stock, or people that have been riding this stock, bag holders that bought this stock at $4 that were stupid enough to keep holding it down to here. They see a rise in price and they freak out and say, oh my god, I gotta get out of this stock while I still can on this strength up here. So it's kind of a revival patterns are kind of a double-edged sword, where it comes with the territory that the stock is so cheap that it could just explode from here, or it could be looked at from the point of view that this stock's a pile of crap. I don't even know why this thing is rallying. Let's short this sucker or take our profits because we bought at 4 and we need to get out of this stock at this high price while we still can. So, that's kind of the double-edged sword effect of the revival pattern. But just you can trade revival patterns. I trade them all the time. You just have to be diligent about setting your stops and sticking to them. Because revival patterns can and do form and create some huge returns on stocks. But moving forward here, this is a potential revival pattern on CHCG. As you can see here, we had this kind of descending wedge pattern was the lead-in trend for the bears. We got that first spike in price plus volume followed by the phase 2 consolidation, and then this actually broke out above this symmetrical triangle on volume. It didn't actually break out above this the horizontal neckline, but it did give this first initial breakout signal as it broke out above the symmetrical triangle resistance line. So I went long at 186. From here, you'd probably want to ride the 13 EMA or about 175 is where it currently stands. So you're looking at about a 10-cent loss on this trade. So going forward, as you can see here, it never broke out above 2, but it still looked like a pretty solid triangular pattern here. So holding it, I was still holding as this was riding the 13 EMA, hoping that it was going to bounce off here and push above 2, which would be a huge breakout signal, breaking that whole number resistance, which probably would have pushed it upwards of, probably 275 to 3. But that's not what happened. The price broke down the 13 EMA right here. I even got out a little later than I should have and sold at 169 for a 9.14% loss. So moving forward, you can see after it broke down this pattern, it just kept riding down all the way down to 125. So just a great example. You need to accept the failure because you can't just hold on to these stocks and hope that they come back up because false breakouts, especially on revival patterns, since the stock's already in a bearish trend, is a good indication that this is not going to be going forward upwards. You need to get out of this stock now before you get stuck in a really big losing position. And now you're sitting down here on your trade. Next up was CHLN. This was another trade that we had gone over on the bull side that I traded for some nice profits. This is another revival pattern, kind of a symmetrical triangle pattern. So buying into these symmetrical triangles, sometimes you can get in at an earlier price because you see the breakout point here, but you're not actually buying above the actual the horizontal neckline. But buying in here, I bought in at 496. On the breakout day, we got this huge volume coming in, so it looks like there could be some potential movement going forward. And resistance is past resistance was right around here from a physical standpoint, as well as there's that whole number resistance, and a breakout above these levels would even push this up possibly to the $7 area. So anyways, I was long at 496. The stock dipped here to about $5 per share, whole number support. 13 EMA is slightly below it down here. So this is a strong support area where you'd either want to buy in the dip or stop out if the stock broke down that level. As you can see here, it broke out and then the stock found support at the 13 EMA excuse me, and had a low here of was breaking down the 13 EMA. I ended up selling again on this day. I was still riding it above the stock was below the 13 EMA, but I was still holding it as it was it didn't break down the lows of that first day below here. So there was still some horizontal resistance. I had being not too diligent, but I was still at not a big loss. I was only at 2.27% loss here, so I wasn't on a big losing trade. So I was still kind of lenient about not selling the stock, as the stock was just kind of riding around where I bought it at. But I eventually sold at 496 here as this was finally breaking down again the 13 EMA, and we were not getting any strength above it, and closing below 5 once again. So moving forward, as you can see here, it never did anything. It kind of bounced off this ascending trend line one more time above 5, but then it eventually went all the way back down to 4. So you see here the 13 EMA breaking down. While it always doesn't mean it's going to completely crash right as it does it, it usually is a typical sign that the stock is going to either slow down its trend and might just chop back and forth through the 13 EMA, or it's going to reverse the trend and start falling. So I cut my last short there for 2.27%. It broke down the 13 EMA, but was still not too big of a loss. So I was still holding it slightly below the 13 EMA, and then finally eventually sold it here when it was just not moving above 5 and it was not moving above the 13 EMA. So going forward, here's Cocoa, Corinthian Colleges. This is a revival pattern. So you can see here we got this lead-in trend that's bearish, followed by this kind of channel pattern, and then this flag breakout. We get that spike in price, followed by the consolidation and a breakout above that $10 per share resistance level. $10 is a pretty significant number in the stock market. So the breakout here, I bought into this with a profit target of around $12 to $13 per share, but in long at 10.18, and then you'd want to sell pretty much if it broke back down below $10 per share. So going forward, you can see here the stock just collapsed. This is a complete false breakdown or breakout. I ended up selling at 960 as this just never came back. It never gave a bounce. I was on this candle. I took about a 6% loss on this trade. This would indicate that it would possibly come all the way back down here, as this was a false breakout. But let's see what happened next. You see here the stock actually came back down and retested the 13 EMA. But if you waited for that, you'd be at a pretty hefty loss before you actually got back down here. So as always, you never know what's going to happen. The stock might rebound and it might come back up. You might have got stopped out, and then the next day it blew up to $20 per share. You never know what a stock's going to do. All you can do is stick to a trading plan and cut your loss short and keep your losses minimal as possible, because if you allow them to get too large, that's when you start getting in trouble and you start having significant losses, which hinder your ability to move forward in the stock market. So here's another revival pattern. So you can see here the lead-in trend was bearish, and then we got this solid neckline formed around $2 per share with this three-phase breakout triangle. So that breakout above $2 per share is a pretty big indication that this stock could be moving forward upwards of the next whole number resistance, as well as price was forming support and resistance around that $3 range as well. So that'd be about your profit target. So I long this at 227. You'd want to keep your stop around a move below this neckline support level, and then if follow the 13 EMA if and when it breaks out above here. So if it breaks down below the support level, you need to just get out of the trade and not screw around and think that the stock is going to go to the moon, because obviously it's not working out in your favor. Get out and move on. So let's see what happened next. I took actually a pretty big loss here, 11.45% on this trade. It was a pretty volatile stock. It was up 20% on this breakout day, and then the next day it had that big candle breakdown right down to the breakout support. And also you can see here I probably should have sold this because it was formed. It broke down and went down below the breakout midpoint breakout support of the candle. So that's a bearish cloud cover candle. So that was a bearish signal as well. And then it actually broke down the 13 EMA on this day as well. I ended up selling at 201 for 11.45% loss. So I try to keep it at a maximum of 10%, but with these small cap stocks, in the $1 to $2 range, they easily make 20% moves in a day. So you can have bigger losses, but you need to try as hard as possible to cut your loss short. So looking forward here, you can see after it broke down the 13 EMA again and failed to rally here, the stock just didn't really do anything and ended up way lower than we bought it at in the lows of the 150 range. All right, so here's another revival pattern. This was Gigam Media. I was buying this stock in anticipation of the breakout. So you can see here the lead-in trend forming in, and then we got this three-phase breakout formation with the solid neckline formed at about $7 per share. So you can see that whole number resistance coming into play. I longed at 671 in anticipation of this breaking out to the upside with a potential profit target of up around $9 per share. $8 is the next whole number, but buying in at 7, you'd be looking at a profit target of about 9 to 10 for a legitimate revival pattern that worked out well. But in any case, So I bought in at 671. You'd want to stop out pretty much on a move below, probably about the 13 EMA. You could write. So if you're buying in anticipation of a breakout, it's usually a good idea to ride the 13 EMA until it either breaks out and then trade the breakout, or if it breaks down the 13 EMA, then get out of your position, as it's obviously looking like this stock isn't actually going to ever break out and make it to phase 3 of the three-phase triangle breakout formation. So going forward, you can see that's exactly what happened. The stock did come back down and retested right around the 13 EMA, but rallied back up and then had a strong candle that broke down the ascending trend line in addition to the 13 EMA. So I took my loss for a negative 6.86% loss, moved on. Obviously the trade isn't working out, so you got to cut your loss and don't screw around and be greedy bastard thinking that this thing is going to come back up and that you're going to make your money back. It's counterproductive to hold on to a losing position. So sell it and put it in something else that looks like it might be working out now. But let's actually take a look what happened next. You can see that this stock broke down here. This is the day I sold. Actually found support again and then broke out above the $7 area on huge volume. So looks now like rebroken triangle. This looks like a legit breakout now. Time to buy, right? But I actually didn't even buy into this revival pattern here on this legitimate breakout pattern. So this is what I was actually waiting for and was trying to buy in anticipation to, but I didn't buy into this stock. Let's see what happened afterwards. Another false breakout. So again, if I did buy into this pattern, I'd have to set a stop loss on a move below this neckline at about 7. And you can see the day after the breakout, it actually did retest the breakout zone around 7. Actually even slightly broke down below it, and then kind of just traded in a mediocre channel here between about $8 and $7 before finally breaking down the breakout support as well as a 13 EMA, and it eventually broke all the way down to $5 per share and a few weeks later. So again, this was an awesome looking, pretty good looking revival pattern here. Huge volume on the breakout. That looks like it's a good time to buy into this revival. But for any trade, the most important thing to do is to be on the defense and act like every trade could be a losing trade. So you need to set a trading plan and set a stop level where you're going to get out of this stock if and when it breaks down that zone. So that's exactly what you would need to do on this trade here. As you can see, it broke down the 13 EMA. As well as the neckline support, and continued to fall all the way down to 5 in just a matter of a few weeks. So you can't hold on to these stocks once they work out. Even if it does break down below here, like I got stopped out, and then shortly later it broke out. Even if it did, blow up from here, I would not be mad whatsoever about being stopped out right here. This stock wasn't working out when I was in the trade, so I need to exit out of this trade with as little of a loss as possible, and not be greedy thinking that it's going to come back up. Because if you try to do that again on this trade and thinking that it's going to come back up again, all of a sudden now you're down at $5 and you're in a huge losing position from you entering in the $7 range. So you just have to be able to cut your loss short. It doesn't matter if you get cut out and then the stock bounces back up. That's going to happen in your life as a trader. The most important thing is that you just stick to a trading plan that allows you to cut your loss short. Overall, you don't want to ever allow a stock to do something like this while you're still holding it after you went long up here. So here is another revival pattern. Surprise, surprise. We got this lead-in trend that is bearish. Past peak resistance up here around $1.50. So we had some 150 resistance here. Next resistance after that is the $2 obviously whole number resistance place, and we got this three-phase breakout formation that broke out here on increased volume. So that was the buy trigger to get in. I went in at long at 140. I was thinking that this 150 level would be easy to break because of this strong momentum going forward out of this pattern here. But looking forward, as you can see, the stock actually didn't ever breach that 150 level. So that's actually the new neckline of the actual revival pattern that you would want to buy into if it did break out above this. But it actually broke down below the neckline support as well as the 13 EMA during the session. I took a little bit too long to get out, and I should have probably got out earlier when it broke down right here, but I didn't sell until I got at 126, and it had a 10% loss, but I kept it within that 10% barrier. Going forward, see what happened here. I got stopped out here, and then the stock just kind of didn't really do anything, dropped all the way down to about 110 levels. So then you'd be at a huge loss, kind of rallied back up, and then came back down. So once it breaks down these chart patterns, the stock usually doesn't really do much for a while after that. So you don't want to be sitting there with your money tied up in some stupid stock that's just doing nothing forever. All we want to do is take advantage of the breakout. It either works out or it doesn't, and so we either get out of our position if we stop out, or we take advantage of the strength when it breaks out and we sell for a gain. Same revival pattern here, leading trend. I bought into this neckline breakout here. So I longed this at 117 on this day of the breakout, and as you can see here, it actually formed a shooting star candle. It was looking strong into the session. I bought it at 117, just below 120, and actually came back down into the close and closed forming this shooting star candle, which is somewhat of an indication that the stock may be halting out here and may be a false breakout. But we did have that increased volume and the neckline breakout. So our resistance and target level would be in the 130 to 150 range, back where price was consolidating and peaked out at. So going forward, as you can see here, this is where I bought on this day, and then the stock kind of just consolidated for a while, and then bounced off the 13 EMA and actually broke out above the pennant formation here, which was another buy signal, and we had that volume increase, but actually topped out at 130, where I wasn't looking to take my profits yet. I wanted to sell up in this area, and then it actually broke down the 13 EMA and broke down this horizontal support with some strength, and I got out at 114 for a small 2.56% loss. And going forward from there, as you can see out, this is where I got stopped out at, and then it went all the way back down to $1. So I'd be at a huge loss if I would have allowed that to happen. But if you bought on a dip at $1, that really strong support level, it did eventually come back up and break out above this neckline support here and moved up to that target that I was looking at 160. But I never bought back into this stock. But what I did is I cut my loss short because the trade looked like it was not going in my direction. And who cares that it came back up eventually? And maybe it would have went down to 60 cents and you're still sitting on it. So the most important thing is that we're trying to minimize risk, not maximize it. Here is another revival pattern. This is OFI. As you can see, your lead-in trend is bearish. Then we have this three-phase breakout triangle formation forming here that broke out on slightly increased volume. The stock was a pretty low liquidity. I actually bought on this dip near the midpoint of the breakout candle, longed it at 495 with a target up above next whole number at 6 and upwards of 7. So in a range right around here, as you can see, the stock kind of consolidated in between 6 and 7 for a little bit here on a short-term scale. So that'd be kind of a range of an area where you would want to look to take profits, and if not, if the trade doesn't go out in your way, you'd want to be setting a stop on a move below. A really aggressive stop would be on a move below the midpoint of the breakout candle or the low of this candle. Then your passive aggressive would be on the breakout down below the actual neckline, and then you could follow the 13 EMA as a trend line support and stop level if and when it breaks above the actual neckline support here. So going forward, you can see that that midpoint broke down after these first few days, and then so I stopped out of this stock at 470 because it wasn't holding above 5. It broke down below the low of that first candle pullback near the midpoint, And now it's sitting right around the 13 EMA as well as the neckline support. But I got aggressive with my stop here as this was breaking down. It even did looks like it broke down the 13 EMA. If you look closely here, it's kind of hard to see on this chart. But anyways, I sold this stock because obviously it looks like it's not working out too well in my favor and not going higher. It's actually coming back down. So sold it at 470 for a 5% loss. And going forward, you can see here after I sold it, that's exactly what it did. It came down, dropped below 13 EMA, it kind of retested it before trending along the 13 EMA for the bearish all the way down to $3 per share. So just another example of why you must cut your loss as short as possible, because many times when these stocks have failed breakouts, they have continuation in trends downwards, and you don't want to be part of that and be one of these stupid idiots that are holding down here at $3 that bought up at here and never had the balls to sell their stock. Here's another revival pattern. As you see, the lead-in trend is bearish. Then we had this longer-term neckline formed here at about $2 per share, and then we had this ascending trend and a three-phase breakout formation formed with a strong breakout above 2 on volume. So I went long this stock at 244, a little bit higher than you'd like. You could either buy in right at the breakout or right around here, or you could buy half up here and then buy half on a dip. But I went long at 244 with my position. As you can see here, the stock never did pull back. It went straight up after I bought in, all the way up to $3 per share. That I never took my profits there, and it did form this bearish doji / shooting star candle. That was a sign of a possible reversal here. I'm not a perfect trader. Sometimes I get greedy as well, and I want the stock to go to 4 rather than 3. So I continued to hold this stock and wanted to trend along the 13 EMA and see how high the stock could go. But there was that resistance here at around $3 per share, which would have been a great profit target from going long on this breakout. But anyways, the stock didn't do that. The stock eventually did break down the 13 EMA right here, and I was just like, I've had enough of this trade. It's not working out in my favor. I was bummed out that I didn't take advantage of that $3 spike. And so it was breaking down the 13 EMA here. I took my very small loss of 2.5% and moved on. So let's see what happened afterwards. I actually stopped out right here. It actually did bounce right after that back up to 275. So I got stopped out here, and as soon as I stopped out, it rallied up, back up to 275 into a position where I would be profitable. But then it never really did anything after that, and just kind of rode up and down between the 13 EMA before finally breaking back down all the way down to $2 per share. So once the stock breaks down 13 EMA, that's typically a sign that the stock is either going to reverse its trend or it might just be choppy along the 13 EMA. So I sold the stock for a loss right here, and then it rallied back up. But that's life. I cut my loss short. I can move on to the trade and put this money towards a better looking stock. Here's another survival / revival play. So you can see here the lead-in trend is bearish, and we got that first spike up for the first phase of the three-phase breakout triangle, and then we got the profit taking. Then so we had a survival breakout pattern here as this broke out. So your profit target would be about 250 or so. And this stock was pretty volatile. You can see this small looking candle here was actually a 22% move. So there was a lot of volatility and risk on this stock. And this is actually the last trade example of this DVD. I just wanted to show you, I'm not a perfect trader. I took a much bigger loss than I should have on this trade. I lost 20%, but going forward, we'll go get into that in a second. Looking at this trade, it broke out above this descending resistance here, looking like it could be breaking out above 2, which would indicate a potential move up to the 250 level at this past price peak, and we got increased volume. But going forward, you can see the next day was actually a big bearish cloud cover candle that broke down below the midpoint of the breakout candle, slightly below the descending trend line, but it was staying above the 13 EMA. And the mistake here was, I was riding the 13 EMA, like following the breakout. As I said before, sometimes you don't want to be riding the 13 EMA right off the bat, and this is a perfect example, kind of the risk involved with doing that. I was going to ride the 13 EMA on this stock after it already had gone up 20%, 22% in a day, and I bought it at $2 per share at the top of that 22% move. So right after I bought into that, that whole 22% gain was gone in one day, putting me at a pretty big loss. And I kept sitting here riding the 13 EMA. Well, I didn't make that big of a mistake by following the 13 EMA, as it was kind of down by this support, but I allowed a 20% loss to be added to my portfolio losses. So I eventually sold the stock at 160 for a 20% loss. That's a pretty big loss. I don't ever want to be part of a 20% loss in my days as trading, and I don't want you to be part of that either. But looking forward, as you can see, what happened there, it broke down the 13 EMA, and then it's all the way back down to $1 from where I bought it up at $2 per share. So you just have to cut your losses as short as possible. You can't become the people that never make it in this game of trading are the people that don't accept that failure is part of the game. And in the game that I play, I lose about half the time. So with this strategy that I just went over in the past about 6 hours of this DVD, you must accept that failures are going to be part of the game, and to win, you have to be able to take your profit and additionally be able to take your loss, because that's equally as important as buying a stock that actually goes up. And you have to be able to take your profit before the stock falls back down, and you can't get greedy about any trade that you make. So anyways, I guess this is it. That was a good time for the past 6 hours sitting here with you guys telling you what I know about the stock market. I hope you enjoyed what I had talked about here, and I look forward to trading with you in the future. Anyways, thanks a lot, everybody.